Welcome back to our latest episode of Gina's Gems, where you get to meet the team behind the scenes. Back by popular demand, we've got a familiar face here today, Krystie Dascoli, our voluntary benefits practice leader. Krystie's back to discuss long-term care and why it is at the top of large employers' wish lists. Hi, Krystie. Thank you so much for coming back.
Yeah, no problem. Great to see you again, Gina.
You as well. I'm not going to ask you for a fun fact because we have so much to cover on this topic. And I'll just start by asking the question, why now, Krystie? I've been talking to clients and prospects about long-term care for a year. So we know what's happened in the long-term care market: rate instability, carriers leaving, rising claims, low mortality, et cetera. So why would employers want to offer long-term care now?
Yeah, that's a great place to start. And there's a couple of reasons. Really, more than ever, people are concerned about their acute and long-term health. COVID really brought that to the forefront in the last 2 years. There's also the personal experience. We have a lot of caregivers in the industry. There's been that demographic shift we've been talking about for years. And, children are taking care of their baby boomer parents. And then, third, healthcare is our number one risk when it comes to protecting our income into retirement. So, a lot of people think Medicare is going to cover them, but reality is Medicare covers about 10% of all long-term care costs. And then really the final thing is that, there's been a lot of legislative activity. Several states are considering enacting a mandatory long-term care payroll tax. Some are even looking to split that payroll tax between the employee and the employer. So we predict that many of these states will not provide a long-term opt-out window, as they really need the participation for the long-term viability of this program.
Yeah, so it's pretty clear that the need is still there, even though the market has shifted. Life expectancy continues to increase, as does the cost of long-term care. So how does Medicare work within the industry?
Yeah, unfortunately, there's a lot of misinformation about Medicare, and it gives a false sense that they have a long-term care waiting for them when they retire. And although Medicare covers some services for long-term care, there are many that it does not. Medicare pays for care that is skilled, and the key word there is skilled. This means that a person providing care must be a skilled registered nurse. For example, Medicare doesn't cover custodial care. This entails providing assistance with daily living activities. Long-term care, as we all know, requires two activities of daily living, two losses of activity of daily living. So, again, it just proves that Medicare is really not the right fit for this. Also, to receive Medicare benefits, you must be 65 or older, have a disability, or have end-stage renal disease. And then, Medicaid, we need to consider that. And for that to kick in, you practically have to spend down all your assets to receive benefits.
Yeah. There also seems to be a pretty big disconnect between what employees want and what employers think they want. So I'm wondering, should long-term care be on the list of priorities along with retirement plans, for example?
Yeah, it definitely should. And we do see a big disconnect there. And, employees will typically place long-term care in their top 4 benefits they want access to from their employer. But many employers don't think of it. They think employees are finding it in other places, or again, that maybe Medicare will cover them. I really believe the bottom line is that most employers are not understanding the real need for the aging population.
Yeah, and when it comes to the types of plans, so we know 20% of long-term care policies sold are traditional plans, and 80% of the industry are hybrid life with an LTC rider. So let's talk about hybrid life. How does it compare to traditional? Is hybrid more expensive? And why is buying it before 65 important?
Yeah, so the best way to break this down is really to think of traditional long-term care as a use it or lose it policy. This means, you buy this long-term care policy to cover your long-term care needs. You could pay for the policy for many, many years, but never qualify for the benefit. Whereas a hybrid long-term care policy is what we call a multi-use policy. These policies include a death benefit, they build cash value, they have terminal illness riders, and of course, they have the long-term care rider as well. So in some way, a hybrid policy will be used. The other thing to note is that traditional long-term care programs will have some underwriting, while hybrid plans offer a guaranteed issue for the employee and usually simplified issue for the spouse. And then when it comes to cost, we have found that premiums are relatively similar to the age groups between 25 to 60. Really, after the age of 60, a traditional long-term care plan will be less expensive, but there will be underwriting. So if the individual has any medical issues, they may not qualify for that traditional long-term care plan. So regardless of the plan that someone purchases, the real key is to purchase these programs at a younger age, as the premiums are level and they don't increase with age.
Yes, I'm living proof of that. For some reason, I bought a long-term care policy in my 20s. So I'm very happy about that. Can you talk about two of the riders, the restoration and extension riders, and are they available in every state?
Yeah, so it's important to understand, how these riders work. So in a hybrid long-term care policy, the insured selects a face amount. So let's say they purchase $100,000 face amount. Typically, the long-term care benefit will pay 4% of that face amount per month. So that would be $4,000 a month that could be used for long-term care. Each month that benefit is paid, it actually reduces the overall face amount. So the average duration for the long-term care benefit with a hybrid plan is 25 months. There are two riders that an employer can elect from in a hybrid long-term care program. The first is a restoration rider. So basically, this rider will restore the face amount to be used for life insurance death benefit. So in our earlier example, if the person purchased $100,000 benefit, used all of their long-term care benefits for those 25 months, this rider would restore the $100,000 back just for the death benefit. The other rider is a long-term care extension rider, and this doubles the duration of the long-term care benefit from 25 months to 50 months. It's really important to note that while these programs are group products and cited in one state, some states do have restrictions on whether these riders can be offered or not.
Got it. A lot of employers might ask the question, we already have an employer paid life insurance plan. Why would we want to offer another life plan?
Yeah, that's a good question. So the two really should sit side by side and really complement each other. Think of term life as for the here and now. It's really meant to cover things like mortgage payments, tuition, college tuition, that here and now. Where a hybrid life program is really meant for end of life planning. Really meant for retirement. Most employers are looking at hybrid life as a long-term care program with an, oh, by the way, it also includes a life insurance component. And that's what we see them positioning to their employees. As we conduct our due diligence in the market, we ensure that the carriers we work with offer a long-term care component that operates like true traditional long-term care in terms of the policy's benefit triggers. We want to make sure that the employees that are buying these programs find it meaningful. It's also interesting that every time we go to market, and we market traditional long-term care alongside the hybrid life with the long-term care, 10 times out of 10, our clients are electing that hybrid program.
Well, there you go. I know we're running out of time here, but can you provide a quick overview of what's happening in Washington with the Washington Cares Fund?
Yeah, so the Washington Cares Fund acts similar to Social Security. The state is charging a 0.58% payroll levy that impacts every person working in the state of Washington, but it only provides benefits to those living in Washington. There's no cap to the tax, and each person is entitled to a lifetime benefit of $36,500 to pay for their long-term care services and supports. There was a brief opt-out period and over 450,000 people applied for the exemption. The tax was supposed to go into effect on 1/1/22, but due to a large amount of those individuals who opted out and some pending lawsuits, Governor Inslee has paused the tax to allow legislators to tweak the program. We do believe this program will move forward, but we do expect that there are going to be some fixes to that current program.
Yeah, stay tuned. We'll keep you updated. Lastly, what about California? I feel like it's already a complicated state.
Yep. Yeah, so there's actually 12 other states looking to implement a similar program. California is leading the way and has already started filings. They've started a task force that's going to recommend options to the governor by the end of this year. We really don't know, what that program is going to look like, so it's really too early to speculate. But I would suspect that the outcome of whatever happens in Washington will impact the direction that California takes.
Great. Thank you so much. And we'll certainly, to anyone watching, we'll keep you posted as those changes continue to occur and keep you updated. Thank you, Krystie, for being here again today and sharing such incredibly valuable information and insight on what we're seeing as one of the hottest topics and trends in the industry. So thanks again for being here.
Bye, Gina. Thank you.